Hawk Nelson, Letters to the President. Here on Democracy Now!, democracynow.org, The War and Peace Report. I'm Amy Goodman with Juan Gonzalez. We go back to my interview with Democratic Congressmember Dennis Kucinich. I spoke to him just before the broadcast. He was headed to the House floor, and I asked him what he said on the House floor earlier, comparing the Congress to the board of Goldman Sachs.
I said, we're the Congress of the United States. We're not the board of Goldman Sachs. Goldman Sachs is struggling to survive, and their former chief is now the head of the U.S. Treasury. He's in a position to be able to direct assets in a way that would help enhance his own financial standing. I mean, that's a clear conflict of interest, and that's something that needs to be said. Why are we permitting the person who has essentially been in a position where he's managed assets that, many of which are now in trouble, and he can come back and help clear the books for a lot of his friends. This is wrong. It's fundamentally wrong. And, it's one of the things that adds a degree of stench to this.
What concessions do you think right now are critical? For example, what do you think should happen to homeowners who've already been foreclosed on or are facing foreclosure?
Well, there's been a number of suggestions about the homeowners, and one is by an economist by the name of Nouriel Roubini, who says that we should come up with a plan that's very similar to what's happened in the 30s, where you have a home loan process called the HOLC, and this would enable homeowners to actually be protected, that people wouldn't go out of their, wouldn't find themselves in a position where they're going to lose their homes. It's called the Homeowners Mortgage Enterprise. And this would be a means of helping several steps that would help assure that we address directly the issue of people losing their homes, often through no fault of their own, and finding themselves in a position where they're not getting any help from the government. Because one of the real conceits of this bill is that it has the word homeowner all over it. But when you look deeper at the fine print of the text, it does not provide any direct aid for homeowners, and doesn't even require that the government set itself on a path to help homeowners. This is not about homeowners. This bill is about bailing out Wall Street speculators with $700 billion of taxpayers' money.
Federal Reserve Chair Ben Bernanke warned lawmakers that an imminent meltdown in financial markets threatens to destroy the wealth and jobs of millions of Americans if this isn't passed. Well,
there's many ways that you can stimulate the economy. One is that you can have massive infrastructure spending. You could get that started right away. It'd have to go far beyond what Congress passed the other day. If you want to spend money into circulation and move the money in the economy, you can do that through spending on things that are tangible: bridges, water systems, sewer systems. You can stimulate the economy by having a national health care plan. I mean, that would take a little bit longer to set up, but that would be a huge break for all these businesses that are having difficulties. There are many ways that we could address this, but the plan that they've put to us, they said this is the only option. Isn't it interesting that the only plan that we get up, for an up or down vote is one that gives a complete bailout to Wall Street without any restraints or protections for the investors who might come into this
Congressman Kucinich, can you explain how it is that the Democrats are in charge, yet the Democrats back down on their demand to give bankruptcy judges authority to alter the terms of mortgages for homeowners facing foreclosure, that Democrats also failed in their attempt to steer a portion of any government profits from the package to affordable housing programs?
Well, I mean, those are two of the most glaring deficiencies in this bill. And I would maintain there was never any intention well, many members of Congress had the intention of helping people who are in foreclosure. This Wall Street doesn't want to do that. Wall Street wants to grab whatever change they can and equity that's left in these properties.
Right, but the Democrats are in charge of this.
Right. I'll tell you something that we were told in our caucus. We were told that that our presidential candidate, when the negotiations started at the White House, said that he didn't want this in this bill. Now, that's what we were told.
You were told that Barack Obama did not want this in the bill.
That they didn't want the bankruptcy provisions in the bill. Now, that's what we were told, and I don't understand why he would say that if he did say that. And I think that there is the fact that we didn't put bankruptcy provisions in, that actually we removed any hope for judges to do any loan modifications or any forbearance. There's no moratorium on mortgage foreclosures in here. So who's really getting help by this bill? This is a bailout, pure and simple, of Wall Street interests who have been involved in speculation. And I don't, for the life of me, understand why this is going to do anything to address the underlying problems in the economy, which actually have to do with the recklessness. This is what the president of the Federal Reserve Bank in Dallas said. That, I might have the actual quote here. Listen to this quote. He said, "The seizures and convulsions we've experienced in the debt and equity markets have been the consequences of a sustained orgy of excess and reckless behavior, not a too tight monetary policy." This is the Dallas Federal Reserve Bank president, Richard Fisher. So, we're getting stampeded here to vote for something that doesn't help homeowners, that doesn't do anything about foreclosures, that doesn't help those people who have been in bankruptcy and are looking for a way out. As a matter of fact, it made sure they can't get out. So who's this for? It's for speculators. It's to play a game that provides some temporary help in the market. And, you might see an uptick today if this passes the House. On the other hand, if it doesn't, we need to be ready to find a way for Wall Street to address its problems without having to tap the increasingly diminishing resources of the federal taxpayers.
And the issue of oversight, Congressman Kucinich, before there was Section 8 saying there was no executive or legislative oversight here.
Well, the word oversight has new meaning here. Oversight could mean I overlooked something. And frankly, the Securities and Exchange Commission looked the other way while all this fast-paced trading was going in derivatives and derivatives of derivatives. We have about $500 trillion. Almost $500 quadrillion of derivatives floating out there that no one really understands how that's going to affect the underlying economy when some of these things start imploding. I think we're looking at a situation here where it is precisely the lack of regulation and the lack of oversight by the administration that has caused this. Congress is going to have hearings next month, but frankly, we should be having hearings now before we pass a bill. I mean, it's just upside down that you have hearings about the underlying problem after you pass a bill, because you have hearings first, you do the analysis, and then you come up with a fix that can protect investors, strengthen the economy. We should be concerned about the strength of the FDIC. We're told that there's more than 100 banks that are in trouble right now and could collapse. We have to make sure depositors' money is protected. This bill doesn't have anything to do with that.
The issue of corporate compensation, according to the Institute for Policy Studies, chief executives of large U.S. companies made an average of $10.5 million last year, 344 times the pay of the average worker.
Well, this is really a fundamental issue in our society. Again, it's all about how the wealth accelerates to the top and how work is not respected or rewarded for its own intrinsic value. We've really moved. We've made a transition in our economy from industrial capitalism to finance capitalism, and with this debt-based economy that we have, where we keep this public and private debt keeps exploding as it did under Alan Greenspan, quadrupling in a period of 20 years. We see ourselves in a position where the debt just keeps building and building and building, and we're calling that economic progress. It is not. We need to challenge again the underlying assumptions about a debt-based economy, about whether or not we should revisit the 1913 Federal Reserve Act, which has unfortunately privatized the monetary system and created a system which includes banks having the ability to create money almost out of thin air with a fractional reserve. We have to look at the implications of that, maybe put the Federal Reserve under the Treasury and have the Treasury really be responsive to the interests of the American people and keeping the economy going. There's, you know, we're looking at the potential here for some positive changes if we address them directly. But what this bill does, unfortunately, it just kind of helps things keep going until the next trillion-dollar crisis, which is coming in a few months, when the Alt-A or jumbo mortgages, which are being reset in 09 and 2010,